I'd like to call the Finance Committee meeting to order, please. Good afternoon. Doug, are there any public comments this afternoon?
No public speakers today, sir.
Okay, then would you please, the next order of business, is the approval of the minutes of our April 23rd Finance Committee meeting. Moved. A second? Thanks, Jim. All in favor? Opposed? Minutes are approved. Doug, the work plan, please.
We have no changes to the work plan either.
Okay, and then would you please go right into Budget Watch?
Yeah, sure. May Budget Watch, we're going to focus on preliminary results from April and May. A lot of the trends are trends that I've spoken about over the past couple months, and they're continuing, but I'm going to go into the details now. Passenger revenues for the month were better than budget by $3.1 million, or 0.8%. That increases the year-to-date favorable variance to $13.6 million, which is 0.9%. A lot of that favorable revenue is coming on the commuter rail side, specifically the Long Island Railroad, and that has to do with favorable weather and higher New York City employment than was projected in the budget. Year-to-date passenger revenue is up 4.3% at the Long Island Railroad and 2.7% for Metro North. New York City Transit is basically on target for the month and year-to-date. Toll revenue was slightly unfavorable at B&T for the second consecutive month. And what's happening there is there's higher Easy Pass usage than was budgeted. And what that does is it results in a greater amount of discounted transactions. So while we're still favorable year-to-date of about $5 or $6 million, we were unfavorable for the month of about $1 million, and about three-quarters of that variance was due to the lower yield, primarily because of the Easy Pass saturation. I'm going to move now to expenses. We're continuing to see the favorable expense trend. We were $22 million favorable for the month, which brings the year-to-date variance up to $87 million. I sound like a broken record, but keep in mind that a lot of that variance is the result of timing delays that will result in higher expenses in the latter part of the year. We will reforecast, our expense trends in the July plan. Those favorable expenses were in spite of increased overtime that was again unfavorable, $2.3 million for the month, which has increased the unfavorable year-to-date variance to $12.2 million. A lot of that is at New York City Transit, where they've had vacancy coverage, and they've marshaled their forces to do some additional maintenance, which has been very positive in terms of the impact on the operation. The other thing you have to remember is even though we're seeing the unfavorable overtime, we're seeing really the offset on the straight-time payroll. So while it's certainly something we're not advocating, it's not the total loss that it appears to be. Debt service was $17 million unfavorable for the month, which brings the year-to-date total pretty much in target with the budget. They're slightly unfavorable by $6 million year-to-date. Has to do with the 2 Broadway certificate of participation being replaced by transportation revenue bond issuances. I'm going to move to subsidies now. We had a good month with the payroll mobility tax. Receipts of $214 million were $77 million favorable, but 50 of it has to do with the timing. If you recall, last month we expected $50 million in replacement funds we said we would get this month, and that's what happened. But even if you take away the 50, that brings us to $26.8 million in real favorable results for the month, which has now offset those unfavorable results we were seeing earlier in the year from the lower bonuses. So that's actually become now a favorable year-to-date, and it's actually become a positive story for the MTA. We've had a few unfavorable subsidy results. The PBT, which is typically a very difficult tax to forecast in terms of variability within the year, that is now $20 million unfavorable year-to-date. Now, we're pretty sure that a lot of that is timing, but just the way it's trending and the variability is slightly in excess of what we might typically see. So we do think that there might be some reduction in that tax. Likewise, the real estate taxes in April of $51 million were $5 million below the adopted budget, and that has increased the unfavorable variance to $15 million. We're pretty steady in that tax. We keep coming in around $50 million a month. We had forecasted slightly above that, so we're not terribly worried about that tax, but we are running just a little bit lower than what we had projected. So to summarize, preliminary results for the month were mixed, with net results being slightly favorable. Again, we have the higher passenger revenue and lower expenses. Unfavorable overtime costs and debt service costs offset some of that. Net subsidies were favorable. Year to date, again, we're very close to budget, slightly favorable, as we have the favorable operating results offset by slightly unfavorable subsidy results, as those favorable PMT taxes are kind of offset by the real estate and PBT taxes and MTAA taxes. So I would say, again, basically on budget, slightly better. And any questions?
Okay, thanks, Tom.
Sure.
Pat, you want to take us into Finance Watch, please?
Sure. Good afternoon. Finance Watch appears on Roman numeral 4-1 of your committee book this month. We have a few transactions to report, the first being conversion and remarketing of the Transportation Revenue Bonds, Series 2002 D1. These bonds have previously been in the variable rate mode with the support of a standby bond purchase agreement from West LB. That bank is no longer participating in the municipal market, and they exited. We determined to take advantage of low fixed rate environment right now, and converted these bonds to fixed rate. And as you can see here, on May 2nd, we had a very attractive pricing that resulted in an all-in true interest cost of 3.44% for these bonds. And that transaction was led by J.P. Morgan together with Duncan Williams, which is a woman-owned underwriter in our co-manager bracket. Next, we have a $9.5 million diesel fuel hedge that we executed on May 4th. This was competitively bid, as all these are, and Bank of America Merrill Lynch won the bid, and the all-in price that we locked in for an 18-month period was $2.99 a gallon for about 176,000 gallons of diesel fuel each month, again going out to November 30th of 2013. And then the last thing I want to report is that we do have an upcoming TBTA transaction, what we'll call the 2012A bonds. This will be $250 million of fixed rate bonds for TBTA's ongoing existing approved capital program. We're actually mailing the preliminary official statement this Wednesday. We'll be pricing next Wednesday, and then expected to close on June 7th. And we're selecting a competitive method of sale for this transaction. And we'll, of course, report on that next month. Sir.
I don't want to interrupt your flow, but I have a question on that one. Can
Sure.
I ask?
That's okay.
Thanks, Bob. Thanks, Pat.
Okay.
It's through competitive bidding. Could you explain why that was selected?
Sure. I think there are a couple reasons why. One, this is the MTA's strongest credit with AA ratings from all three agencies. So very well-known, well-regarded credit in the market. Secondly, the size of the issue lends itself to a competitive method of sale. This is a size that's easily bid in the competitive space, and we consulted with our financial advisor, Lamont, on that question and determined that we thought we would get a really strong execution. Again, the market conditions seem to be very favorable right now. We're in historic low-rate conditions, and we thought this would be the appropriate strategy with this credit.
But if you do competitive bid, is there an ability, if market conditions warrant or would recommend ordinarily, to do some type of refunding component to that, or no?
Well, as you know, the standing board authorization for refundings that meet the board refunding policy exists. So while we could certainly add a refunding issue to this, we don't anticipate doing that. That's certainly, we're obviously targeting significant refundings that we expect to do later in the year. But in the current environment, advanced refundings still come with a fair amount of negative arbitrage, which we would prefer to avoid. So we're not anticipating that need to come in with an advanced refunding issue here. Thanks. Sure. Okay. that concludes finance. Oh, I'm sorry. Yeah, no, I do want to talk about our roadshow. There was a travel group. Yeah, I think so. There were a group of us that went out on the road last week to meet with our large institutional investors around the country. It included myself, Deputy Finance Director Olga Chernat, Assistant Director Laura Muldoon, and Deputy General Counsel for Public Finance Kathy McManus. We also had representatives from Lamont, our financial advisor. So we began last Monday in San Francisco, traveled to Chicago, met with investors in Chicago, traveled to Philadelphia, New Hampshire, and Boston, Massachusetts. We had 12 individual meetings with large institutions, and we had 2 large group meetings, one in Chicago and one in Boston. Again, anticipating the significant capital markets activity that we're expecting later this year with those current refunding candidates, we wanted to get out in front of investors, meet with them, present the current condition of the MTA, the financial condition, and then hear their questions, get some feedback from them about how they were perceiving the credits. I would characterize the meetings as very good meetings, good discussions. We have some follow-ups we need to get back with a few investors on. But generally, I think it was a very positive effort to, again, keep our communication with the investment community open, and I think that we achieved that goal. So anyway. Okay. And for what it's worth, we did, the presentation that we used for these meetings, we did put up on the website. We made it available to everybody. We wanted to, again, our sort of key theme here was that we want to be very transparent and open with the investors, and part of that is just making sure that the materials are available to anybody, even those that we didn't meet with. And I think we...
Okay, thanks, Pat. That was a good report.
Sure.
Doug, you want to do the action items?
Yeah,
please?
we have 2 headquarters and all agency items, one of which is the approval of remarketing agent. Do you want to talk about that, Pat?
Sure.
Okay.
This is in anticipation of the necessary remarketing of some TBTA bonds, where we have a bank from Germany that's exiting the business, is not renewing its facility. We've identified a $100 million facility from TD Bank that we would expect to use. I would just note that we're still negotiating with that bank. It's not resolved. However, given the timing that existing facility expires on July 7th, we wanted to have this approval to have the remarketing agent aspect of the transaction approved. TD Bank is not currently on the board-approved list of remarketing agents. The reason why is that back in 2010, when we issued our RFP, they did not have a fully staffed New York Muni office. They have since added a significant amount of capability there, and that's noted in the staff summary on page 5-1 here, that the bank currently has a variable rate demand portfolio of approximately $2.4 billion, and that includes other notable New York issuers. So it's our view, after reviewing the information, that the bank is certainly capable as a remarketing agent. Again, I would just caution that we're still negotiating with the bank itself for the standby bond purchase agreement. If we can conclude those negotiations, and then we would recommend having TD Bank as remarketing agent as well. The interests of the bank and the remarketing arm are aligned, and that is the recommendation before the committee this afternoon.
Yes.
Yes, this is an action item.
Okay, so motion, please.
Motion made.
A second, please.
Second.
All in favor? All opposed? So moved.
Thank you.
Okay, we have one other action item. It's station maintenance billing, and it's to obtain MTA Board approval to issue the station maintenance billing to New York City and the counties of the MTA region for the period April 1, 2011 to March 31, 2012.
Okay, second, please. Please, second. Okay, all in favor? Any opposed? Okay, so moved.
Okay. We have one MTA headquarter report and information item, and that's the annual pension report. Maggie Connor is here to take any questions if anyone has any.
This doesn't need a vote, does it? It's just
This
a
is just an
report.
information
Just a
item. It
report.
doesn't,
Okay.
doesn't require a vote.
Okay, so then if any of my fellow board members would like to ask Maggie any questions, otherwise the exhibit is in our book, and I looked at it, it should be pretty much self-explanatory, but if there's any questions, please. Okay, Maggie, you got off real easy. Go. Yep. Okay, then procurements.
Yeah, staying within the headquarters, we have 4 competitive procurements for headquarters for a grand total of $5,824,385.
Okay, a motion, please. Second, please. All in favor? Any opposed? So moved.
Thank you. Next, we're going to move to the Commuter Rail Committee. We have one action item for the Long Island Railroad requesting board authorization for the MTA Real Estate Department and the Long Island Railroad to enter into 3 agreements necessary to effectuate Phase 1 of the Moynihan Station Development Project.
Okay, a motion, please. Second. All in favor? Any opposed? So moved.
Moving to procurements, there are 4 procurements for a grand total of $31,264,163. 3 procurements for Metro North, which are broken down as 2 non-competitive and 1 competitive with capital construction. For Long Island Railroad, there is 1 competitive procurement requesting MTA Board ratification.
Motion, please. Yep, Jim made one. Okay, second, please. Second, please. All in favor? Any opposed? So moved.
We're moving next to MTA bus operations. There's 1 non-competitive procurement with New York City Transit for an estimated grand total of $30,100,175.
Okay, motion, please. Second, please. Second. Thank you. All in favor? Any opposed? So moved.
Next, we have bridges and tunnels. There are 2 competitive procurements for a grand total of $6,334,971.
Motion, please. Second, please. All in favor? Any opposed? So moved.
Moving next to New York City Transit Committee. 1 action item, which is to obtain MTA Board approval to add ADA accessibility Dykeman Street Station project to the 2010 to 2014 capital program, and to advance this new project into the construction phase concurrent with the station normal replacement currently underway.
We had a big discussion about that at Transit, so I'll move it.
Okay.
All in favor? Opposed? So moved.
There are 4 procurements for New York City Transit for a grand total of $38,819,140. 1 is a non-competitive procurement for ratification. 3 are competitive procurements, 1 with capital construction, 2 are for ratification, and 1 is for modification.
Okay, motion, please. Second, please. All in favor? Any opposed? So moved.
Next, we have First Mutual Transportation Assurance Company. There are no procurements. However, we have the annual presentation to the board by Lorraine Coyne.
Welcome, Lorraine.
This on? Okay. Good afternoon, Chairman and committee members. We're here this afternoon to report to you and the committee on the 2011 activities and operations of the First Mutual Transportation Assurance Company. I will update you on the insurance market and some of our recent renewals. And Dwight, a Femtech's investment manager, will report on the performance of the investment accounts. Okay. The MTA's insurance policies renew at various times throughout the year, but 2 of the major all-agency programs renewed in the past 6 months. The excess liability program renewed October 31st, 2011 with a 9% premium increase. The all-agency terrorism policy renewed on May 1 at the expiring premium terms and conditions. The all-agency property insurance program renewal, though, was impacted by a hardening market, which was a result of historic worldwide property losses, as well as our own claim for Tropical Storm Irene, which exerted upward pressure on pricing. On a combined basis, we were able to renew, combined being the property and the terrorism program, at 2012 budgeted levels, but a 13% increase in premium compared to 2011. And in order to exert pressure on the market pricing, we elected to purchase some insurance ourselves in certain layers and to absorb approximately a 4% total risk of the program. As you recall, the New York City metropolitan area braced for a hurricane to hit the weekend of August 27th and 28th last summer. The MTA undertook system-wide storm preparation, including the movement and storage of equipment, drain clearing, eventual shutdown of service from noon on Saturday until the evening of Sunday. Fortunately for us, by the time Irene hit our area, it was reduced to a tropical storm, which nonetheless brought devastation to certain areas, most notably the Port Jervis line on Metro North. Since the days following the storm, the Risk and Insurance Management Department has worked closely with FEMA, our insurance carriers, and the agencies to maximize recovery for the physical losses, as well as the extra expense incurred for preparation and recovery, and in addition, the loss of revenue due to some of the business interruption. While we're still finalizing our costs, we are considering this all-agency gross loss to be approximately $70 million. The all-agency property program, which has a self-insured retention of $25 million, covers capital and operating expenses for labor, materials, and loss of revenue. Much of the claim has been finalized, and we are in the process of responding to requests from FEMA and the insurance underwriters for all the necessary backup to further substantiate our claim. The process is lengthy and tedious, but we expect a successful resolution, hopefully by the end of the year and into the first quarter of next year. And I'd be happy to answer any questions you might have on the storm and the storm claim. Okay.
Do we have any maybe you said this and I missed it, but is there an update on the insurance, whether that's going to come through or when or for how much?
Well, we've actually received a partial payment. We're just receiving a partial payment now of $5 million. But that there's a kind of it's like a puzzle the way it works in terms of who reimburses what. We have finalized our FEMA project worksheets, which are in the area of about $28 million. And once we might start to begin to receive some of that recovery by the end of the year. And then the insurance will flow after that once we finalize the costs and get back on certain things that we're still supplying.
The rebuilding of the Port Jervis line alone was a substantial amount.
Yes.
Probably a good piece of the 70.
It was about 30 to
35.
Yeah, about 35 exactly. So, okay. Good. Okay. And then the next slide just shows you a list of the various Femtech managed accounts and their values as of 3/31, and also exactly what pieces of the insurance company of Femtech are actually covered within each of those accounts, which of the insurance programs. Okay. So if there are no questions, I'd like to introduce Sean Sire from Dwight, who will take us through the investment returns.
Great. Thanks, Lorraine. Good afternoon. One of the things I wanted to start off with today, there's two primary things I'd like to touch, and I'll be as appropriately brief as I can. The first will be obviously a portfolio review. I've started with a little bit of a market overview to begin with, but the second topic I want to just bring up at the end of my remarks is organizational change at Dwight. So two things I'll start with. I'll start with the update. The slide you have in front of you right now is really just to give you an idea of how the fixed income markets in particular have performed over the last 12 months with the period ending March 31st of 2012. Since I only have an opportunity to really be here annually, I wanted to give a snapshot of effectively what's happened over the last 12 months. And really what this is showing you is that the blue bars kind of going off to the dark blue to the right-hand side suggest that during those intervening 12 months, performance in fixed income was actually quite strong. And you can see with even treasuries have returned almost 8.5% during that period of time. The light blue bars take a look at what the excess return has been, and that's defined effectively as the return for each of those sectors over and above treasuries that have the same average maturity. And so what you can see is that, for example, CMBS and ABS, those sectors have both performed well versus duration equivalent treasuries. But you'll notice that that corporates did not, and particularly financials. And we kind of go back and look at, they had certainly weakness in the second half, in the third quarter of 2011. Part of that was associated with things that were going on in Greece, and some of the problems that were being manifesting in themselves over here in the U.S. And if we kind of think about where things are standing today, the exact same thing is kind of rearing its ugly head again. The first quarter of this year was a tremendously good quarter for most investment sectors, all with the exception of treasuries. People were buying risk, and people were buying corporates and CMBS and so on. And since basically the beginning of April, that and the news that's come out of Greece and all the concerns there and everyone's read about have turned investors around, and they're starting to flee again towards safety. And so you're starting to see kind of a risk-off trade happening right now. And so both equities and fixed income, basically from April 1 through today, have been quite weak. But for this 12-month period of time, it was quite strong. If you turn to the next page, you take a snapshot of actual performance. Again, I give a number of different time periods here for each of the different portfolios. But I was going to focus on the 1 year, that 12-month period again, that corresponds with the first page, and I'll also give you a little bit of update as it relates to the last 3 months as well. But performance, as you can see, as you look down each portfolio versus its own benchmark, actually performed relatively well, outperforming modestly in most cases over that 12-month period of time. And that was primarily due to the fact that, on average, we have an overweight to treasuries, and we have a modestly an underweight to some of the particularly financial and bank names that have come under stress recently. So that positioning has paid off relatively well for the portfolio, at least it did for that 12-month period up through March. And then what's happened since March is that you can see the performance for the 3-month period was poor versus the prior 12 months. And really that's a reflection of exactly what I mentioned a minute ago, is that performance in the first quarter for everything except treasuries was quite strong. We had an overweight to treasuries, so that hurt us a bit. And if we were to take a look at snapshot today, if you will, from basically the end of March through now, performance versus the benchmarks is going to be strong again because treasuries have rebounded and other asset classes have been a bit off. If you turn to the last page, we can take a look at a quick snapshot of, in aggregate for the entire FemTAC portfolio, how we're positioned, and give you some idea of what the statistics are as well year over year. So if you look down toward the bottom second half of this page, you'll notice we give you a snapshot of where book value and market value were a year ago when they were in March of 2012. And one thing you can see, if you look at the delta between market and book a year ago and the delta today, you realize that the market value to book value kind of ratio has actually increased. So we've seen an increase in market value over that period of time, which is, it goes along and is concomitant with the type of performance that we had during that 12-month period. But certainly book yield as well as market yield is down, and that's due to the fact that rates really came down dramatically over that period of time. I think the 5-year Treasury is down about 123 basis points over that period of time, and the 10-year almost substantially similar. So despite what was happening in the markets, as you put any new money to work, so any principal and interest that we had to reinvest, certainly we were reinvesting at lower rates, which had a downward bias on both book yield and market yield. But duration, or our average maturity, effectively is kind of kept relatively stable. Our outlook really right now is to be effectively neutral to perhaps a little bit long from a duration perspective, and certainly average credit quality hasn't changed. We've kept that at AA-, and the outlook would be to continue to keep that at a relatively high quality. And going forward, from an opportunities perspective, we're going to continue to put money to work, again, principal and interest as it comes available. We like the ABS sector. We're a bit neutral right now in CMBS. We do like corporates. Fundamentals and balance sheets, we think, from the corporate perspective, are still quite strong. And even in an environment where we kind of muddle along, perhaps at 2.25% growth, we still think that corporates are a good place to invest money. Any questions I could answer there? Yeah.
The source of funds that represents our principal invested is what?
Insurance premiums.
That's the 300 and something million dollars. That's
Yes.
all insurance
All
premiums.
insurance premiums, yes.
Nothing else.
No, the original funding for First Mutual in 1997, December 15th, 1997, was about approximately $3 million from the MTA in startup funds, and then that money was returned to the MTA. So it's all the insurance programs that are in.
Thank you.
Okay.
And the one other note I did want to make, as I mentioned, there were two topics I wanted to raise. One was the portfolio review. The other was the organizational change. So for the prior, I'm sorry.
Just one other quick item on the presentation, which I think is very enlightening. Do you think there's a benefit to showing the portfolio segments in either dollars or percentages on the income page in future years, just so one understands, where you're making the yield and how it sort of gets weighted? I know you have it broken down in the back, but there it's somewhat inaccessible, and it also is not spot on with the front.
We certainly can do that. Absolutely.
Thanks.
Thank you.
Very good presentation this year. Unlike 2 years ago, you remember? This was well done. I think.
I had one more
Oh, I'm
comment
sorry.
that I think is appropriate and important to bring up is that. No, it was on.
Oh, it was on, okay.
Was that for the last 5.5 years, 6 years I've been coming to you here, I've been here representing Dwight Asset Management Company, and I now here representing Goldman Sachs Asset Management, and that's due to the fact that just on last Tuesday, Goldman purchased Dwight Asset Management Company. So Dwight is effectively a stable value manager, and we also manage insurance. But the insurance business now has been assumed by Goldman Asset Management, and so going forward, all of the fixed income, the research, the analysis, everything that's done with respect to the portfolio management is being done by Goldman. I have been retained as a Goldman employee. I will continue to be the portfolio manager for Femtech, so that will not change. But I think from a resource perspective and capabilities, this is an upgrade from MTA's perspective, in the fact that there's a lot more resources that can be brought to bear in portfolio management for Femtech.
Thank you very much.
Okay, thank you.
Thank you. Okay, that concludes the finance part of our meeting, and I'd like to turn the meeting over to Jeff for the real estate agenda.
Okay. Thanks, Andrew. Before I get to the action items, I'd just like to say we have 4 particularly significant RFPs we expect to be issuing in the short term, 2 at Grand Central, which I think I hinted at when we were announcing the Apple transaction. We keep endeavoring to find additional space there to lease, and particularly to find good spaces for restaurant uses, as metros were closed. We've managed to assemble a parcel consisting of the current Hot and Crusty space, Francesco's Salon, and some space behind Hot and Crusty, as well as the western side of Vanderbilt Hall, which we're going to make available for kind of mixed restaurant, grab-and-go, and cafe use. We expect a lot of interest in that. We also are going to be issuing an RFP for a restaurant space above the market, and we, again, anticipate keen interest in that space. Also, I want to mention that we will be out shortly with RFPs for master leases for retail complexes, one at Columbus Circle, about 11,000 square feet of retail there, and the other for the Fulton Street Transit Center, now called Fulton Center, Joe, officially? ER, right? Okay. And Yeah, we have, the market is actually in a new building. It's a sort of an interstitial building between the Lexington Passage and the Graybar Passage. And there's some back of the house space up there, some storage. MTA Police have a facility up there. It was studied for restaurant use in early days, but I think at the time the retail wasn't as well established in the terminal and was considered an iffier proposition. We're going to carry that forward. There's an entrance to that space on Lexington with a canopy of its own and has some visibility from the market as well.
What did you say about the Vanderbilt Hall, the west end of it?
Right. We're going to continue to have the holiday fair in the entire hall, but for as much as 10 months of the year, we envision a cafe use in that space to be supported out of the Francesco's Salon, which is up the stairs from Shuttle Passage, is actually at the level of Vanderbilt.
Oh, okay.
Okay.
So this is the west end of the waiting room, basically.
The old waiting room, yeah. Turning to the action items, we have 4 of them. There's a newsstand to the high bidder. We also have a batch of taxi concessions for the Long Island Railroad. We managed to increase our revenue under these concessions by some 75%, in spite of the fact that most of them have been retained by incumbents, so we're happy with that result. And then we have 2 short-term lease extensions, one on Sutphin Boulevard for Long Island Railroad, the other for New York City Transit on Jackson Avenue. As you know, our office right-sizing strategy involves making a series of moves, densifying to Broadway, revisiting the BSC use at 34th Street, and so on. That's going to take some while. These leases were up for renewal or expiration. They had, in each case, provided for a 5-year extension option. Our Andrew Greenberg of our department has done an excellent job of negotiating short-term extensions instead, so we're not exercising the renewal options. We managed to keep our low rents at those locations flat or slightly down, increasing our updating our base year for taxes. So recommending approval for extensions of those leases in the near term. We'll have up to 2 years there, but termination options to be exercised on 10 months' notice in each case.
Okay, so motion, please.
Can I ask a question on the taxi issue? I noticed in reading the materials that, at least from my reading of it, maybe I misread something, all of the current incumbents won the new bid.
No, I don't believe that's right. I think there are actually 4 that did not. Do I have that right, John? Right.
I'm sorry, I didn't hear that.
I believe it was 8 were retained and 4 were not by incumbents.
Okay.
Is that right? Yeah.
Okay, so
Okay.
may we please have a motion? Second, please. All in favor? Any opposed? Jeff is set.
Thank you.
And now we need a motion, please, to adjourn our meeting. Second, please. All in favor? Opposed? I don't think so.